Hello, peeps, and welcome to day 3 of the Sly Foundation series. Today, we're going to be talking about liquidity, that is, where price is most likely headed. This lesson today introduces one of the most powerful concepts in modern trading, but I'm going to try as possible to keep it as simple as necessary. Our objective for today's lesson is that at the end of the lesson, you should be able to understand what liquidity is. You should be able to identify equal highs and equal lows. You should also be able to know why price sweeps highs and lows. And with all that, you should stop seeing the market as just some random movements. You should see the movement of markets. You should see the purpose behind the movement of market. Yeah, that's it. So, quick introduction. Yesterday we learned how to identify who is in control of the market. That is structure, right? And we're going to answer a different question today. Where is price trying to go? And the answer is usually price is seeking liquidity. So, firstly, we need to know what liquidity is. So, what is liquidity? Simply put, liquidity is a collection of orders in the market. That is where many traders have placed either their stop losses or their pending buy or sell orders. Yeah, so all those places are known as liquidity pools where those orders are, right? And the market is usually attracted to those areas where liquidity is resting. So, yeah, equal highs and equal lows. Let me just show you from this chart right here now. If you look at this, if you look at these two spots where I'm joining with my line, let me mark it again. Here and right here. Those two places are equal highs. When traders see these kind of things, they see it as a resistance level, and they usually place either their stop losses for a sell order, or they place their sell orders there too. You understand? Different types of traders exist, so different types of orders will exist there too. So that is an example of equal highs. Liquidity exists at equal highs and equal lows, session highs and lows. But for those of us who trade synthetic indices, we don't really bother ourselves with sessions because the market is not affected by sessions. That is, the synthetic indices is not really affected by sessions, neither is it affected by news event and all that. So we are mostly technical in our analysis. So liquidity, I said, rests at session highs, daily highs and daily lows, equal highs and equal lows. We've seen equal highs here. This could be an example of equal lows. So also structural swing points, structural swing high and swing lows. So those are the main places where we can see liquidity and where liquidity exists. So I said price is usually attracted to this point. Now, if you can see this, let's look at this pool that we have here. Let me even use a line to mark it. Let's use a line to mark it. If I place this line here, right there, joining those two spots, you can see here now that price did a little movement here like this, swept the liquidity pool here, and then went down. That liquidity is what fueled this movement downward. So until price gives us a break and close above that level, that is not really a break, it is a sweep of liquidity, and it's because of the orders that are resting there. Okay, so liquidity sweep, that's an example of liquidity sweep. Price takes out the high, doesn't really close above it, then it reverses kind of, or goes down. And the reverse is the case for a bearish liquidity sweep, that is to take out of equal lows. Let me look for an example. In this one, in this place here, this place where we have our equal lows, price when price approached it, it didn't give a sweep, but it still went ahead and closed below it. So that's not really a sweep that I'm looking for. Let me look for where I can show you a liquidity sweep. I've shown you a bullish one. It's a bearish one now I'm looking for. Okay, now look at this place. It's not necessarily a sweep of equal lows, but it is a sweep of a low. Look at this swing low here. Liquidity actually exists there, and then see what price did with this candle. Price moved down from here. Then with that green candle, it just wicked the level. It did not close it. Let's place this line there. Okay, so place the line there. Then if I zoom in, you'll see clearer what I'm talking about. Okay, sorry, I'm still moving the line. Let me click out. So if I zoom in, you'll see what I'm talking about. This candle, price just wicked it, and after that wick, you see that aggressive move upward. That is an example of liquidity sweeping, a bearish liquidity being swept, and then price reversed. Now I want to disabuse your mind of something. Liquidity sweep is not always an automatic license for price to just reverse or give you an aggressive move. It only means that liquidity has been taken. Sometimes it might give you that aggressive move. So there are some mistakes that beginner traders make, like selling immediately at equal highs or buying immediately at equal lows, assuming that every sweep is a manipulation, ignoring market structure. This liquidity and the sweep of liquidity still has to be applied with structure in mind. Remember, what we are learning is the framework, SLY framework, right? Structure, liquidity, then yield point. All these things have to come together. It's not just because you see a liquidity pool, a sweep of that liquidity, and then you just assume that, since okay, maybe if the liquidity is being swept to the downside, you should now take a buy immediately. No, your structure has to be considered. The direction of the market, what story is it telling by its movement? All those things have to be considered before deciding whether the liquidity in question is a usable one, and whether the sweep of the liquidity is going to give you what you want, right? um okay, so let us still just keep looking at price movement. Now, in this our case, we said structure comes first, Abby, then liquidity comes second. If you look at this, you know that the structure here is giving us swing high, swing low, swing high here, swing low. At this point, before the formation, let's say from here, before all these candles here formed, our expectation is, because we know this high, this low have formed, and then price went up to take out this high. But look closely. This move did not really break and close above this high. So that is actually a liquidity sweep. Before price now came again downward and swept this liquidity again, then went ahead to confirm this close. What does that mean? This liquidity sweep here is the fuel for this movement, right? Okay, so then swing low here, and all of this manipulation, continuation, breaking this. So you see that structure being obeyed, being maintained, where you have swing low, swing high, swing low, swing high. From this swing high, the ultimate swing low would be this. Let's clean up a bit. Swing high here, swing low, swing high, swing low. But this swing high is not really considered much of a swing high because it did not close above this previous one. So swing high here, right? Swing high here, and then This is not the swing low because this swing low did not lead to the close to the break of this one. So price still continued having internal movements here until we had this move upward that broke this high. So this here would be considered the um, swing low or the structural swing low. Yes, structural swing low. So with this lesson today, I think I have also done a revision for you people on what was yesterday's lesson again? Structure, price market structure, right? Okay, so for today's practical exercise, we are going to be doing, okay, just open any chart of your choice, right? Identify one area of equal highs, equal swing highs, and one area of equal swing lows. Then with your eyes, look for um okay, when you identify the swing highs or the swing lows, that's equal swing highs or swing lows. Tell me, which liquidity pool would you, if you were the market price, if you were the price move, the price that is moving, which liquidity pool would you attack? And tell me why. So do that, do the screenshots, mark the equal highs and equal lows, and then tell me which liquidity pool you would attack if you were market price, and tell me why you would attack it. So I hope this lesson has been informative. I try as much as possible to make these lessons very short so that we don't lose attention. You understand? The human brain kind of has an attention span, so I try to just limit the length of this video. I hope I have, within this short time, they will be able to um, give you valuable information. This is Sly, and we're still learning the Sly framework. Today was day 3. Tomorrow will be day 4, and we'll be talking about yield zones, right? I think so. That should be the next thing um on our schedule. All right, guys. Make use of this information how you wish and have a great trading time. Fly out.